Hello and welcome to episode number 99 of the podcast So You Want to Start a Business. My name is Ingrid Thompson and thank you so much for joining us. There are 98 episodes before this one, and the next episode is going to be episode 100, and it is a cracker, if I may say so myself. So I'm reading the book in this episode. I've been reading we're up to chapter 5. Part 1 of chapter 5, it starts to look at your structure, and we looked at what to think about in terms of, are you having a business you want to keep forever, or is it a business you want to build to sell, or are you creating a lifestyle business, whatever that means for you? All are terrific options. If you want to grab your book online, bookshops online sell it. You can race into your local bookshop. Bookshops in Sydney have it. Bookshops around the world stock it. And I was looking at my report, and there are books being sold around the world every week. Thank you so much for buying the book, whether it's the online copy or the physical hard copy. Oh, I'm having a bit of a mumble this morning. Okay, this chapter is part 2 of chapter 5, and we're going to look at what is the structure you need in the United States. In the US, it's necessary to take into account both the legal and the tax considerations when selecting a business structure. Which business structure you choose determines your income tax return form that you need to fill in. So the most common structures available in the US: sole proprietorship, partnership, C corporation, S corporation, or a limited liability corporation, which is referred to as an LLC. So choosing the right structure is important, and understanding why that particular structure is right for you is equally important. So what I'm doing here is providing you with some information, and as we always say, go chat to your legal people, chat to your accountant about what is the right thing for your personal circumstances based on you and whoever else is involved with your finances. So whether that's family or other people, so it's your personal situation, but here's some information so we can understand what they actually mean. So a sole proprietorship, this is the most common business structure. If you're operating your business as a solo operator, or your business is part-time or based on a hobby or personal interest, then sole proprietorship is the simplest business structure. The structure is inexpensive to set up because there are few legal and tax formalities. If you operate your business as a sole proprietorship, you trade on your own and you control and manage the business. You're legally responsible for all aspects of the business. The debts, the losses cannot be shared. All the income received and expenses incurred are included on your personal income tax return form number 1040, available at www.irs.gov. You would also complete a Schedule C, a Form 1040, or a Schedule C-EZ, Form 1040. Schedule C helps you calculate the profit or loss in your business, and the amount, which is called the bottom line amount, on the form is then transferred to your personal tax return. You need to keep detailed records of expenses and all income earned. You also need to complete a Schedule SE, which stands for self-employment, along with your Form 1040. This calculates how much self-employment tax you owe. The estimated taxes owed are then paid in 4 equal amounts throughout the year. With a sole proprietorship, your business earnings are taxed only once. Of course, you will need to check with your accountant to ensure you're paying the correct amount of tax. Okay, so it's quite complicated, isn't it? So there's forms to fill in for your tax, and there's also the form to fill in to calculate how much they refer to as the bottom line amount. So that's if you're a sole proprietorship. Partnership. When it comes to entering into a partnership, structure in the US is similar considerations as were factors in Australia. The book here says, please refer to the previous section. So I'll go back and read you parts of that previous section. So what I wrote about regarding partnerships in Australia, it said that having a legal and formal partnership agreement is not essential, although it's highly recommended, and it certainly is. I remember a few years ago teaching my How to Start a Business class, and there were 3 young men contemplating a partnership structure for their business, and I suggested the importance of seeking legal advice to ensure they started off with the best possible agreement. Another participant in the course commented, "But isn't it really expensive to go to a lawyer?" Well, yes, it can be, but it's not nearly as expensive as it might be if you don't. The courts and mediation practices are filled with partnerships gone wrong. I often meet people who think that a partnership is a good solution to having the necessary support to create a business. And it's easy to believe that you'll be best friends forever because right now the excitement and enthusiasm are driving and carrying you forward. When things get sticky due to difference of opinion or cash flow issues, however, it can be great to have thought through some of the things while you are in the planning stages. If you're thinking about setting up a formal partnership as your business structure, here are a few questions to consider. Do you have the same vision for the business as the other potential partners? Do you have the same approach to risk? How are you going to apportion the workload? Who will be responsible for which tasks and operations? Will you set up a board? How will the partners be made accountable for their roles? How will you deal with differences of opinion? What will be the trigger to sell or wind up the partnership or buy out the other partners? A terrific episode of this podcast is episode number 1, where Adam Franklin set up his business with his grade 1 best friend. And all these years later, the business is flourishing and their friendship is solid. There's also another episode coming up. If you're listening to this one as episode number 99, there's an episode coming up in a few weeks' time about another partnership. And these are two men who went to school together. They were in high school together and they always knew they were going to start a business. So it's a pretty terrific episode as well. Stay in tune for that one. So it's all about being clear right from the outset, beginning with the end in mind, applies to considering partnerships as a business structure. As I've always said, good advice from a lawyer and an accountant is critical. So choosing the right structure is important. So back to the other structures in the US. So sole proprietorship and partnership are unincorporated options. Incorporated options involve shares and shareholders. There's more paperwork involved in the setup and when it comes to the ongoing tax returns and other legal filing requirements. An advantage, however, can be that limited liability, which generally means an arm's length distance between the business and the personal assets of the shareholders. So we'll look at a couple of these different options. So a C corporation. To form a corporation, prospective shareholders provide money, property, or both in exchange for capital stock in the corporation. When it comes to calculating taxable income, the deductions that apply to the corporation are generally similar to the sole proprietorship. A corporation can also take special deductions, for example, regarding local and sales taxes paid. For federal income tax purposes, a C corporation is recognised as a separate tax-paying entity. A corporation conducts business, realises net income or loss, pays taxes, and distributes profits to shareholders. If the corporation makes a profit, the corporation pays tax as and when the profit is earned. Profit is taxed again when it is distributed to the shareholders as dividend. This creates a double tax. There's no tax deduction when a corporation distributes dividends to shareholders. Shareholders cannot deduct any loss of the corporation. An S corporation is a way to avoid the double taxation on corporate income tax that is associated with a C corp. The corporate income losses, deductions, and credits are passed through their shareholders for federal tax purposes. Shareholders of S corporations report the flow-through of income and losses on their personal tax returns and are assessed tax at their individual income tax rates. So that's the difference between the S and the C corps. So then there's a limited liability company. LLC is a business structure allowed by state structure. It's regulated by local jurisdiction. There are a few ways that LLC may offer greater flexibility for your business. Check with your local state for the regulations under their statute. Most states do not restrict ownership of the LLC, which means it can be owned by a range of legal entities, and in most cases there is no maximum number of members or owners. Another point of flexibility is that most states allow single-member LLCs, which means that there can be just one owner. The IRS treats one-member LLCs as a sole proprietorship for tax purposes. This means that the LLC itself does not pay taxes and does not have to file a return with the IRS. A sole owner of an LLC must report all profits or losses of the LLC on a Schedule C and submit it with their 1040 tax return. There are two other important matters for US businesses to address: an EIN, Employer Identification Number. The EIN is used to identify a business entity and is used to track all the financial transactions of a business. Individuals have social security numbers and a business has an EIN. The EIN is recorded on every business invoice and tax return. You can apply online on the IRS website. It doesn't take that long to complete the application online. Most people can complete it in 10 to 15 minutes, and you usually receive the number immediately. You can only apply, however, during the IRS hours of operation. So head over to irs.gov and actually type in to Google, apply for an Employer Identification Number online, EIN, and it'll take you to the page. In the book, it actually has the link. I'll put it in the show notes. Sales tax is another important aspect for US business to consider. Sales tax is state-driven, which means that each state has its own rules about which products and services attract sales tax and what amount of sales tax is to be collected. And these laws are constantly changing. Most states have a destination-based philosophy for collecting sales tax. What this means is that the sales tax is applicable when the product is used. Origin-based states require the merchant charges to the sales tax at the point where the transaction takes place, usually the location of the merchant. When researching for the book and my online program So You Want to Start a Pilates Business, I had a discussion with a sales tax specialist, Mark Best, regarding Pilates businesses. He highlighted for me the big differences you see in the laws by referring to the yoga exemption and the great yoga sales tax wars that took place in 2012. The result of these was that yoga, not officially being considered exercise for sales tax purposes in New York City. Sales tax really is a matter for the experts, so contact an accountant with sales tax expertise. So now an activity for you, your business structure. As I said at the start of this segment, begin with the end in mind. So look at the descriptions and go back and listen through each of the descriptions for the business structures and consider the pros and cons of each and decide which structure will work best for you. Remember, it's super important to consult a lawyer, attorney, and/or your accountant. Ultimately, the decision is yours to make in conjunction with your legal advisors. It's worth spending a bit of time on this, however, in order to best set up yourself for success. Next, we'll turn to some other considerations. How risky all of this is. So in the next section, I'm going to read you the part about risk management and insurances. But for now, we've had two parts of Chapter 5 looking at the business structure. It truly is a part to make a decision about. Once you've got it set up, it's yours for a while, and you can change it if you want to. I think that's the important thing. I always, when I'm talking to clients that I'm working with, I suggest starting with the simplest structure. If you're starting a simple business, a lifestyle business, or something that is really about you and your expertise, and it's a business that's going to be a health practice, an exercise or fitness business, selling flowers at your local market or foodstuffs. If you're selling something that is really taking your hobby into a lifestyle business, then perhaps a simple structure is for you. If you imagine that down the track you're going to franchise or you want to sell, then it's probably really and truly worth having a really good think about setting up something a bit more complex that will give you a bit more structure for your business. Remembering that some of the downsides to having the more complex structure is that it requires more paperwork, it requires more input from your accountants, and that leads to more cost. It does, however, give you a solid structure as a business. So truly something to think about. As always, my email address, ingrid@healthynumbers.com.au. There's no advertising on this podcast apart from me and my book, and then my guests also get to share their business when they're on the show. Stay tuned for episode number 100 coming your way very, very soon. And just go out and do what you have to do. Take some actions, maybe scroll back and have another listen. This is a little bit complicated, but truly, I am here to help you. Your accountant, your lawyer, these people are here to help you. Go to your local business centre. They have people that can help you with this as well. So until the next time, I'll see you in episode number 100.